A big week behind us with a big focus on central banks like the FOMC and the Bank of England. One cut, but both are pointing towards a highly data-dependent approach. And that's going to be particularly interesting in the week ahead because we're going to get data from those two exact countries, CPI out of the US, and then we have GDP and the jobs report out of the UK as we move into yet another week that should be a very busy one when it comes to markets. So let's look at the week ahead for the week starting Monday, the 12th of May. So first and foremost, we'll look at the top tier items as we always do. And it's kicking off on Tuesday with a couple of releases out of Australia, the Westpac Consumer Confidence figure and the NAB Business Confidence. Then the UK jobs report. We've got the ZEW Economic Sentiment Index out of Germany, inflation out of the US. And then Thursday really is the next big day, and that has the raft of GDP data, industrial production, manufacturing production, and the like out of the UK. GDP also coming out of Japan, retail sales out of the US alongside PPI. And then on Friday, we've got the Michigan Consumer Sentiment Survey, which has been particularly interesting of late. And so let's kick off with the US. Like I said, Tuesday's really the big one because we see this inflation data. Now, bear in mind, we've just come off the back of an FOMC meeting. They paused as markets had expected. But expectations for the next rate cut did shift quite significantly. They moved away from the June rate cut and instead pointed towards July as being the first rate cut for this phase, essentially. So why has that happened? Well, ultimately, there's fear around inflation and fear around stagflation. So stagflation means that essentially the question mark is, what's the health of the US economy like, and which one is going to roll over first? Now, some would say that even if we did see inflation turn upwards, the question mark here is whether we also see the economy turn down. And if we see a weakening of the economy and a rise in terms of inflation, there is a good chance that that the Federal Reserve still cuts rates because of the fact that they essentially say that inflation is transitory in nature. If it's a one-off bump and in a year's time it just drops out, then perhaps it's less troublesome than something that is inherent within the economy at that time. Now, of course, there's big uncertainty given the fact that we don't necessarily know what's going to happen with the US and China in particular. We've seen trade deals between the UK and the US, so we've seen the first across the line. But bearing in mind that the UK has a trade deficit with the US, so this should be a relatively easy one to do. And it's also a trade deal that's been a long time in the making. Quite exactly how we're going to progress with the weekend discussions kicking off between the US and China and Switzerland, that remains to be seen. But certainly if we did see some sort of breakthrough, that sort of dramatic reduction in tariffs, then that would be great. But I just can't see this happening instantaneously. It's going to take some time. There's likely to be some concern about that. And the longer it plays out, the more we have potential for that inflationary surge coming into play. Like I said, at the back end of the week, we've also got plenty of other figures to be looking out for. And notably, we've got the likes of the Empire State Manufacturing Index, the Philadelphia Fed Manufacturing Index, and the University of Michigan Consumer Sentiment and Inflation Expectations numbers. They will be a particularly interesting raft of data points because of the fact that we have seen a surge in terms of number of these manufacturing index prices paid or prices elements. So the inflation metrics within the manufacturing sector really pointing towards inflation becoming a problem. Now, I'm going to create a separate video for US inflation. So make sure to check that out because I've got charts for all these kind of things. But we're keeping it a little bit more simple on this because, of course, we're trying to wrap up a wider picture within this. And instead, let's just look at the outlook in terms of expectations for rate cuts and the implications in terms of what that might mean for a market. In this occasion, it's gold. Now, bear in mind, I've inverted gold. So what this means essentially is if we see things that make it more likely that we see rate cuts, it's good for gold. If we see things that make it more likely that we're going to see a pause, then it's bad for gold. That means higher inflation should be bad for gold. If we see a weak inflation gauge coming out, then that means the possibility of additional easing from the Federal Reserve. It means the possibility of higher prices for gold. Now, bear in mind, of course, gold has been doing well over the course of the year thus far, pulling back a little bit here. And it's an interesting one because it's coming at the same time that we're seeing, say, crypto rising. And so both of them in a way are a play against sort of over leveraged economies, the ramping up of debt, the move away from the fiat system. One of them is more of a haven. One of them is more of a sort of risk on asset. And so it's likely that gold is likely to do well at a time when perhaps we see additional easing from the Federal Reserve being priced in. But that goes hand in hand with perhaps a weaker economy, right? So if we're seeing additional easing, then that would likely, to our mind, mean that the Federal Reserve sees signs that the US economy really needs help, right? And that's not necessarily good for equity markets, but that would be good for gold. So let's jump onto the chart for gold, and we can see right here that we've got this recent pullback coming into play. Now, the long-term trend is an encouraging one, right? And you might say, why would I buy gold at this point? I'm essentially buying at a top, right? But I mean, you could probably say that at any point during this, right? Like, who's to say where the top is within this? It's a trend, and a very reliable trend at that. Now, what we can see here is, of course, that we saw this sort of falling wedge pattern here. Let's just draw this on here. So we had this sort of wedge formation here. I've just got this box that's annoyingly in my way. There we go. So there we go. So we've got this wedge. We've got the breakout, the rally up through your near-term sort of initial resistance level came with a rally through 3353. Now we're pulling back at the moment, but in my mind, I deem this to be a retracement after we've bottomed out here. And so you'd be looking for potential support to come in here at 3292 or 3257. That's the 61.8 and the 76.4 Fibonacci retracement levels. Now, ultimately, like I said, if we're coming out with data that essentially points towards a worsening of the economy, an additional sort of pulling forward in terms of rate expectations, that would be good for the likes of gold in my mind. Because if we're looking in terms of sort of recent trajectory, let's look at, say, SPX, put that on a new scale. So let's look at exactly what the correlation is at the moment between equities and gold. So as we can see here on the short term, we've got this inverse correlation, right? And so it's not necessarily perfect, because like what we've seen here was a dip in terms of the S&P 500, and it wasn't much of a dip, but we saw this, you could almost say, a rip with gold, right? Because this shows you that like the moment that we saw this pullback on the strength of the S&P 500, we had 9 consecutive days of gains. We then saw a bit of a pullback. People started saying, oh, this is the S&P 500 going to roll over in a meaningful manner. And what happened with gold? It just rallied straight up here, right? So we can see that there is definitely the demand there for gold if we do see the market start to top out over the near term. And so certainly if we start to see some of these data points coming out on the weak side, I think personally that would benefit gold. It would likely increase the likelihood of additional rate cuts from the Federal Reserve. And so that's the way I think it's playing out. We were pulling back at the moment, but as soon as we see signs of either weak inflation, which to some would mean a weak economy, or the likes of the industrial production numbers coming in weak or things like that, right? That's the kind of thing that I think would really benefit gold. So certainly one to watch, very positive trend. Of course, this trend doesn't necessarily, it's not going to last forever. But certainly the trend still remains in play. And with the pullback that we're seeing at the moment, I think there's a good chance that we see a retracement. But like I said, a lot of it's going to be data dependent, right? So if we're coming out with really strong economic data, it's going to be a risk on move coming into play. So yeah, an interesting one to be watching out for at the moment. And certainly if we start to see a deterioration in terms of the data, a ramping up in terms of calls for rate cuts, then that signals the likeliness of gold to come back into play and start to rally once again, despite the current pullback. So then let's look at, here we go. Excuse me. The UK economy, there's a raft of data coming out. Of course, it's been a very busy week, to say the least. We've seen the Bank of England coming out with their interest rate decision. They voted to cut rates. 2 of the 9 members opted to vote against a rate cut. 2 of them voted for a 50 basis point cut. So there's certainly no consensus between the group. Now, the group didn't necessarily think, or markets didn't necessarily think, oh, well, because one's voted for 50, it eradicates the fact that 2 have voted to pause. Instead, markets took it as a relatively bullish sign for the pound. And that at least gives us an idea of where things are going for the time being. So let's look at this, right? So essentially, markets are starting to pull back on their expectations over just how quick the Bank of England is going to be cutting interest rates going forward, in part because of the fact that we've seen an additional 2 members voting against at this initial stage, whereas people thought we were going to be ramping up the easing in a meaningful manner. If something voting against now when we thought it was going to be 9-0, then what's going to happen next time around? So people are pulling back from those expectations. Now, what would we need for those expectations to change in favor of additional rate cuts? Well, a worsening of the economy. Inflation, in my mind, I don't think is necessarily going to be a massive problem in the UK because we have the downside risks of the sort of slowdown in the world led by the sort of tariffs. And we don't necessarily have the same inflation problem because we haven't enacted tariffs on goods coming into the country. So how are we looking at this? Well, we've got the jobs report coming out on Tuesday, unemployment, average earnings, employment change. If we see a rise in terms of unemployment, if we see the employment change figure coming in weak, if we see a weak GDP figure on Thursday, remember we've got the quarterly figure, the year-on-year figure, the month-on-month figure, industrial production, manufacturing production, a lot of data coming out. If we see a worsening of the UK environment, then you're going to be expecting to see additional calls for rate cuts from the Bank of England going forward. Now, in terms of inflation, let's see what we got here. We've got inflation. We've got the Bank of England. So inflation thus far has been largely under control, like I said, but it's been sort of flatlining for the time being. So the question mark here is, are we seeing inflation causing a problem? If not, then it just comes down to the picture of the UK economy. Or does it need to see the Bank of England stepping in a meaningful manner or not? And inflation core is at 3.4, so it's still relatively elevated. But if you look at the 9-month annualized, in a few months' time, we could drop down into the sort of mid-2s for both headline and core. So that provides the basis for the Bank of England to potentially move. Now, the expectation, like I said, has shifted now. And that's because now June is not necessarily the live meeting that people thought it had been. 20% chance of a pause, markets are currently pricing. Previously, that was much higher than that. And the base case scenario was, 20% for a cut, 80% for a pause. The cut expectations were much higher previously. So people are now pricing a little bit more of a patient approach from the Bank of England. And like I said, if we see this data coming out and it's coming on the weak side, then all of a sudden we're expecting to see the Bank of England cutting to a faster degree. Now, let's look at the likes of the pound against the US dollar. And here we go. Let's go full screen. So we can see from a wider perspective, you're seeing a possibility of it sort of topping out at the moment. We've seen a strong rally in terms of the pound. What's notable here is that we've seen this divergence in terms of the ratio between the UK 2-year and the US 2-year. Now, I'm using the 2-year yield because it's more relevant to expectations over what the Fed and what the Bank of England are going to be doing. The Federal Reserve much more likely to be in a position where they're going to have to pause down to inflation compared to the UK. Now, there is the caveat of that they might look beyond the inflation picture for the time being because of the tariffs, but that's not necessarily a given because there's also a risk that inflation can become embedded into the economy. Now, what we can see here is that we've got this interesting move where, in actual fact, around the sort of April, beginning part of April, we saw this divergence. So ultimately, what was usually a close correlation, once we saw the Independence Day, Liberation Day, we saw this divergence, and that's some of the moves associated with the rise in terms of yields over in the US as people perceived higher risk. But if you look at the nearer term trajectory, you can see that that relationship's now continued apace, right? So we've sort of seen this gap, the divergence, but then the resumption of that trend between the UK 2-year and the US 2-year ratio, and then pound against the US dollar ratio. So what does that mean? Well, it means if we see data that signals that the Bank of England is going to cut rates at a faster degree, then it's likely we're going to see weakness in terms of cable. If we see something that points towards the US Federal Reserve having to cut to a faster degree, then there's a possibility of this moving towards the upside, and cable moves towards the upside as well. So keep an eye out for some of this data. Certainly, if we see weakness for some of this data, it points towards a possibility of the Bank of England moving more quickly, and it points towards a possibility of this market rolling over. Certainly, as things stand, there looks to be a distinct possibility of that for the near term, because as you can see here, the sort of top end is starting to give way. We're seeing, there we go, we're seeing higher highs turn into lower highs, and so we've got this sort of head and shoulders formation that if we break through the 13233, looks like it could give way to a period of weakness. Like I was talking about, we have got this data coming out over the course of the week, and a raft of it when it comes to the jobs data, the GDP numbers, the industrial production and manufacturing production, a whole host of data coming out over the course of the week for the UK and the US. But that points towards significant volatility for this currency pair. And in particular, if one country all of a sudden sees increased calls for interest rate cuts due to a worsening of the economic environment, then that could really influence the likes of cable, because of the fact that we have got that positive correlation coming back into play once again between the UK and the US 2-year yield. So that's how we're looking at these two markets at the moment. I hope it's been useful. Like I said, I'm making a separate video soon for the US inflation gauge. Lots to look through in that one, particularly interesting one. So make sure to join me on that. I'll continue to provide content for you guys at the number of different channels that we provide it on. Other than that, follow, like, subscribe. We're trying to grow the channel, so all interactions are appreciated. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day, great weekend, and a great week ahead.